All right, let's dive into our first secret, the leverage advantage. Trester highlights that options offer outstanding leverage with limited risk. This is a crucial concept to grasp. Instead of buying expensive stocks outright, you can control a large number of shares with a relatively small investment in options. This magnifies your potential gains, but also caps your potential losses to the premium you paid for the option. Think of it this way. Imagine you believe a stock currently trading at $100 is going to rise to $110 in the next month. You could buy 10 shares of the stock for $1,000. If you're right, you'll make $100. How can you navigate this complex landscape and increase your odds of success? The problem most novice option traders face is a lack of education and realistic expectations. They dive in head first, often based on hunches or gut feelings, and quickly get burned. Trester stresses the importance of education. But education alone isn't enough. You need a system, a framework for making informed decisions. And the solution we'll explore today is to leverage the power of we'll take some of Trester's core concepts and translate them into quantifiable metrics that we can then, this allows us to remove emotion from the equation and make data-driven decisions. By the end of this video, you'll have a solid understanding of key option trading principles and a glimpse into how you can use so. Let's get started. All right, let's dive into our first secret, the leverage advantage. Trester highlights that options offer outstanding leverage with limited risk. This is a crucial concept to grasp. Instead of buying expensive stocks outright, you can control a large number of shares with a relatively small investment in options. This magnifies your potential gains, but also caps your potential losses to the premium you paid for the option. Think of it this way. Imagine you believe a stock currently trading at $100 is going to rise to $110 in the next month. You could buy 10 shares of the stock for $1,000. If you're right, you'll make $100. Alternatively, you could buy an option contract that gives you the right to buy 100 shares of that stock at $105 within the next month. This option might cost you $200. If the stock hits $110, you can exercise your option, buy the shares at $105, and immediately sell them for $110, making a $300 profit after accounting for the initial $200 option cost. That's a 150% return on your $200 investment compared to a 10% return on your $1,000 stock purchase. Now, it's important to remember that leverage is a double-edged sword. If the stock doesn't reach $105 by the expiration date, your option will expire worthless, and you'll lose your $200. But that's the key. Your losses are capped at your initial investment. This limited risk is what makes options so attractive, especially in volatile markets. Trester emphasizes that during the bear market of 2000 to 2002, owning options could have greatly limited losses compared to holding high-flying tech stocks. Options allow you to participate in the upside potential of the stock while mitigating the downside risk. This is the power of leverage, and it's a fundamental concept for any option trader. Next up, let's talk about paper trading. Trester strongly advises beginners to play on paper before risking real money. This is like a preseason game where you can make mistakes without financial consequences. The idea is to simulate real trades and track your performance to gain confidence and familiarity with the options market. When you paper trade, you're not emotionally invested, so you can act rationally and make objective decisions. This is crucial because, as Trester points out, risk and greed come into play when real money is on the line. The ego can also get in the way, leading to impulsive and irrational trades. Paper trading helps you develop a disciplined approach and identify potential pitfalls before they cost you real money. Think of it as learning to drive a car in a simulator before hitting the open road. You can experiment with different strategies, make mistakes, and learn from them without crashing and burning. You can also get a feel for the mechanics of option trading, such as placing orders, understanding option chains, and calculating potential profits and losses. However, Trester also cautions against paper trading for too long. He argues that real learning only occurs when real money is on the line. There's a certain psychological element to trading that you can't replicate in a simulated environment. So, While paper trading is a valuable starting point, it's essential to eventually transition to trading with small amounts of real money to gain a truly realistic experience. The key is to find the right balance between preparation and action. Let's move on to a critical concept that could be even with all the analytical tools and market knowledge. Trester suggests assuming you'll only be right about your predictions 60% of the time. This might sound pessimistic, but it's actually a very realistic and practical approach. The reality is that the market is unpredictable, and even the best analysts are wrong a significant portion of the time. The 60% rule forces you to design option strategies that can still be profitable even if your predictions are incorrect more often than you'd like. This means focusing on strategies with a higher probability of success, such as covered call writing or credit spreads, which we will not cover today. Now, how can we, for example, we can simulate a strategy where we buy a call option and set a profit target and a stop-loss level. We can then run thousands of simulations, assuming that we're only right 60% of the time about the stock reaching our profit target before hitting our stop-loss. This will give us a realistic estimate of the strategy's expected return and risk. The 60% rule is a powerful tool for managing expectations and designing robust option strategies. By acknowledging the inherent uncertainty of a market, you can make more informed decisions and increase your chances of long-term success. This you can adjust the win_rate, profit_target, and stop_loss parameters to see how they affect the overall. This is like a preseason game where you can make mistakes without financial consequences. The idea is to simulate real trades and track your performance to gain confidence and familiarity with the options market. When you paper trade, you're not emotionally invested, so you can act rationally and make objective decisions, strategies that can still be profitable even if your predictions are incorrect. This highlights the importance of carefully considering these factors when designing your option strategies. There are limitations to what you can first. The market is constantly changing, and what worked in the past may not work in the future. Backtesting can give you valuable insights, but it's not a guarantee of future success. You need to continuously monitor your strategies and adapt them to changing market conditions. You need to understand the underlying principles, the risks involved, and the potential pitfalls. It's tempting to override you. The key is to stick to your system and trust the data. Use it wisely and be aware of its limitations. So, there you have it, a glimpse into the world of 101 option trading secrets and how you can use. We've covered the leverage advantage, the importance of paper trading, the 60% rule, and how the book is packed with valuable insights and strategies that can help you become a more successful option trader. Now, I want to hear from you. What are your biggest challenges in option trading? What strategies have you found to be most effective? And how are you using technology to improve your trading outcomes? Here are a few questions to get the discussion started. 1. What's one option trading secret from the book that resonated with you? 2, 3. What are some other ways to let's learn from each other and build a community of informed and successful option traders?